The Peloton roller coaster, a case study in hypergrowth and a historic collapse. This visual illustrates that journey with a red line dramatically rising and then sharply falling. Meet the characters in our story. Revenue, the star of our show, represents the total money coming in. Watch how it grows from an optimistic player to a towering giant and then shrinks dramatically. Costs, the ever-present burden, represents inventory, manufacturing, and losses. See how it balloons from manageable to a crushing weight. Customer experience, the voice of the customer, measured in support tickets, tracks the journey from manageable service to overwhelming demand and finally to customer frustration. FY 2019. In fiscal year 2019, Peloton was a strong, growing business with a manageable financial structure. Revenue was robust and costs were in check, reaching $915 million. The pandemic catalyst. As the world locked down, at-home fitness exploded. Peloton's revenue nearly doubled in a single year as the company raced to meet unprecedented demand. Customer support requests also nearly doubled as the user base surged. This resulted in $1.825 billion, representing plus 99% growth. We see the strong growth, the strain of meeting demand, and the impact on customer support. The peak of hubris. Revenue reached $4.021 billion. The hypergrowth continued, with revenue soaring another 120%. Peloton was the undisputed king of at-home fitness. Believing this trend was permanent, the company invested heavily. Inventory on the books swelled to over $1 billion. By August 2021, support tickets had surged by 90% from March 2020 levels, signaling significant operational strain. This led to increasing costs and a declining customer experience. As the world reopened, the tide turned. For the first time, revenue began to decline, falling by 11%. The true shock was the cost. The company posted a net loss of $2.83 billion as massive investments in manufacturing and inventory collided with falling demand. We saw revenue at $3.582 billion, but this was dwarfed by the impact of our costs, leading to a significant $2.83 billion net loss. The visual here illustrates this struggle, with our revenue figure appearing downtrodden, while a large block representing costs crushes one of our figures, symbolizing the immense pressure faced by the company. A loss of historic proportions. The $2.83 billion lost in FY 2022 was more than the company had lost between 2017 and 2021 combined. As you can see from the chart, the FY 2022 loss of $2.83 billion dwarfs all previous losses from 2017 through 2021. The collapse accelerates. The decline steepened. Revenue fell another 22% to $2.8 billion as the post-pandemic reality set in. The company continued to bleed cash, posting another net loss of $1.161 billion while dealing with customer demands for refunds. We're seeing a 22% revenue decline. Customer experience is demanding, people want refunds, and the weight of costs is pressing down on revenue, which is shown as $2.805 billion. FY 2024. In a stunning reversal, Peloton spent $0 on manufacturing its own bikes and treads between July and December 2022. The company that had been building factories like crazy was now shutting them down entirely to burn through its massive inventory. Revenue continued its decline. The visual elements reinforce this. Factories are marked closed, and characters representing revenue, costs, and customer experience all appear stressed or declining. From Wall Street darling to cautionary tale, this chart illustrates the volatile journey of a stock's price from 2019 to 2024. Starting with its IPO in early 2019, the stock saw a significant surge as the pandemic began in early 2020, reaching a peak of approximately $160 by mid-2021. However, as the world reopened, the stock price began a sharp decline. Even after a CEO was replaced in 2022, the downward trend continued, eventually reaching a bottom of approximately $6 by early 2024. The financial roller coaster in one view. Looking at our revenue in billions, we can see a significant journey. Starting in fiscal year 2019, revenue stood at $915 million. By fiscal year 2020, it surged to $1.825 billion, representing a remarkable 99% growth. This upward trend continued into fiscal year 2021, which marked our peak at $4.021 billion, a staggering 120% increase from the previous year. However, the trend then reversed. In fiscal year 2022, revenue declined to $3.582 billion, an 11% drop. The decline accelerated in fiscal year 2023, falling to $2.805 billion, a 22% decrease. For fiscal year 2024, our estimated revenue is $2.62 billion. 3 critical lessons. 1. Demand whiplash. Misreading a temporary black swan event, a pandemic, as a permanent shift in consumer behavior. The danger of extrapolating unprecedented growth rates into the future. 2. The bullwhip effect. Scaling operations, factories, inventory based on peak demand created a massive, costly surplus when demand normalized. Inventory grew from manageable to a $1 billion plus liability that crippled the balance sheet. 3. The experience paradox. Hypergrowth overwhelmed the company's ability to serve its customers, damaging the premium brand it had built. Surging support tickets were an early warning sign of operational and brand strain. From an $80 billion valuation to a fight for survival, we've seen a dramatic shift from over $160 to less than $10. After one of the most dramatic rises and falls in recent business history, the question is no longer about growth, but about survival.